Welcome to Strike a Chord,
Good morning, good morning.
episode 3.
Yeah.
Here we are.
Episode 3, here
the
we are,
last time
indeed.
that we were taping, we were cordless. Because
Cordless.
we
Oh,
had
yes.
we had the FPs talking about what we're hearing from clients. So it was sort of funny that came up. And we're making all these chord jokes. It's pretty good. I'm so proud of ourselves.
All right.
So today our session is called Huddle, and it's
Okay.
meant to be like the sort of behind the scenes, a peek at what the investment committee, what the investment team is talking about, and not at the CFA analytical level that we know that you guys do. That's why all of us pay you to do what you do. But I'm here to make sure that it's in English, so like I could understand it. So that's going to be what I'm going to draw out of you guys. We all know that you're smarter than the rest of us, and we pay you to be smarter than the rest of us and manage our money. So, this is just sort of, Chord and I had talked about having, just a recap of 2025. So if you get the impression that I'm trying to make it higher level or English, or that's it. But anyway, this is a peek behind the curtain. So, let's see where we go. Okay. So what do you give us a recap of 2025? You want to start with stocks? What do you?
Yeah.
I think we should start with the fact that 2025 was a wonderful year for our clients because they were all happy. And it was also great because we stayed the course. And from an investment committee standpoint, it was really focused on not listening to the headlines, but doing what we always do. And it paid off.
Mm-hmm.
And so
And there were no shortage of headlines, that's for sure.
that's correct. And
Yeah.
so the end result is what counts. Happy clients.
Yeah,
So
for sure.
so it was a great year.
Well, and how do you guys dissect the headlines, right? I mean, we know the media is out there saying, this is what you should be hearing, but you guys have to really dissect that and get down into the facts. And then, so how do you do that? Like, does it take days? Does it take a week? We don't react to everything? Like, what does that look like when you're looking at the markets and, I don't know, some blurb that comes up about a political thing or something?
Yeah, I mean, so first and foremost, we don't react
Yeah.
to the headlines. There's a lot of noise out there. There's always going to be a ton of noise. And so we try to stay focused on what really matters, what really drives the markets over the long term. That's going to be fundamentals. And
What does that mean?
fundamentals in terms of, how much earnings, how much profits are companies generating. That's what really drives stock returns over the long term. And corporate fundamentals were strong coming into the year, and they remained resilient despite all the noise and the headlines.
Okay, so in English, that is like companies were doing well.
Companies were
Right,
doing well.
they were profitable.
They generated a ton of money last year.
Right,
in earnings.
and
Yep.
so therefore their stock grew in value, and over the course. I'm sorry, but this is just right.
but
right,
that's
and
good.
so therefore the headlines didn't really impact them either because they sort of did the same thing and stayed the course.
Yep,
Right.
absolutely.
Like without a reaction to whatever.
Well, in today's computerized world, right, these selling orders are triggered by certain words that take place, and it's sort of shoot first and then evaluate. And so we've seen that pattern over the years, and as technology develops, the speed of those decisions are going to go faster and faster. And so it behooves us to go ahead and evaluate the background, like Chord pointed out, look at the earnings, look at the forecast of earnings, because the markets always look ahead, right? They don't look back. They always look ahead. And just sort of look at what is the underlying interest rate environment, what is the fiscal policy. I mean, some of those things are also taken into consideration, but
Like
it's
yeah,
just
but
basically
in general,
in
that's sort of
general-
complicated. That's what I'm talking about. It's the complicated stuff that you guys do, right, behind the
Right.
scenes, and without delving into all those things, I mean, you guys make a plan. I mean, essentially, you're making a strategic plan
Strategic plan to stick to
that we
Right.
stick
good
to.
times and bad times.
Right. And
Yeah.
sometimes we make tactical changes.
We do.
Yeah.
Right. Did we
absolutely.
make any tactical changes this year that were hugely impactful, one up or down, like one way or the other?
No major dynamic or tactical allocation changes were made. We did swap out one of our active managers for 2 new active managers to help navigate the new environment that we're in.
Yeah.
That was the only major
Yeah.
broad sweeping
Did-
portfolio
I like-
change. Outside of that, I'd say the investment team was really focused throughout the year in keeping portfolios aligned with their target allocations and keeping risk levels.
So how do we do that? Like, the market was good, right? Like every time you looked at it, it was up. And so how do you know when and then what do you do if okay, this is up, so it's out of balance, so to speak. How do you then make those decisions that it makes sense to do it now? And are we tactical in that? Like,
Yeah, can I go back a little bit? Because we talked about the headlines and all that, and I think this is really an important point. Discipline is critical, right? And you can't let emotions creep into your decision.
I'd say it's one of our biggest jobs is
Right.
to remove emotions.
Wouldn't you agree?
Yep.
Right? And so, because
I mean, you
it's
guys
people's,
have to
it's
walk
people's
into investment
money.
committee sometimes and go, "Oh my gosh, we got this going on," right? And you sort
Right.
of have to talk each other off the ledge. There's not just the two of you on investment committee. There's a group on investment committee. But
Right. But I think that's very applicable because now I'll let Chord finish his part in terms of what happens if there are gyrations and tactical moves and whatnot. It goes back to the discipline piece, right? You want to make sure that your allocations are the way they should be as a result of different variations in asset classes and whatnot. And that requires discipline. The emotion is not only going down when the market goes down, but sometimes it also plays a role when the markets go up. And you have to have the discipline not to be greedy and basically make certain tactical decisions there. So if I had to pick a word, I would say discipline is really the key word. Would you agree with that?
Yeah, no, absolutely. Couldn't agree more. I'd say discipline is where the rebalancing comes in. It's a disciplined way to continually sell high and buy low.
Right.
So let's say, good year like last year, markets were up double digits. If you have a 60% equity allocation within your portfolio, and that got to, let's see, eventually at some point in the year, got to 65%, which is where we establish bandwidths for portfolios. Well, then we trimmed that overweight, brought it back to the target level that we're looking to allocate to ensure risk is aligned,
right,
just to help prepare for the unpredictable.
right. And you do that on a very customized portfolio by portfolio basis for the most part.
We do.
Right? You
Yeah.
don't, you're not blanket saying, okay, we're going to rebalance back to.
No,
Yeah.
we're certainly not. And we're also taking into account, any sort of transaction costs as well as taxes. Taxes are a big thing.
Right, right. And I guess long-term gain versus if we had a short-term gain, you might not rebalance somebody right away.
Yep,
Right.
absolutely.
Right. So there's lots of consideration.
We
that
look to
goes into-
avoid short-term gains at all costs.
Yeah.
So
Yeah.
not only do we customize, the portfolios, but what's very important is also to educate our clients. Most people just look at one side of the equation, which is the return. And you've also got to look at the other side of the equation, which is risk, right?
Right.
And so there again, that's where the education comes along and why discipline is so important to make these tactical changes.
So back to like the market was good. Was it like, there's some years that it's a couple of stocks or one sector, one industry. Like was it sort of a broad, all boats rise with the tide kind of thing, or was it a few select stocks?
That's a great question, and that was a healthy sign of last year. Is that it was really a broad-based rally and return across all 11 sectors of the S&P 500, and
Okay.
so all 11 sectors were positive for the year. It wasn't driven by a handful of the stocks that had driven returns in the prior years, which a lot of people call the Magnificent Seven stocks.
Yeah, what are those 7?
So those are going to be essentially your 7 largest tech companies that
Yeah.
have really driven a bulk of the returns. And so, for instance, Apple, Google, Amazon, Nvidia,
right?
Yeah.
those are all going to be included in the Magnificent Seven.
Yeah.
but-
And those are really the drivers. And everybody kept talking, is this a tech bubble? And is this, yeah.
Yeah,
But not
those
true
more
in
the-
25.
Not true in 25. Actually, only 2 of the 7 members of the Magnificent Seven group actually outperformed the S&P 500.
Ah.
Yeah.
Oh, that's cool. That's an interesting
so
The other thing that's really interesting about 2025 is the fact that the international markets did extremely well. I mean, I know we're focusing a little bit on the US here, but the fact that the dollar was weak, which even compounded the returns, and the fact that both Europe and Asia, just to pick 2 geographic areas, grew economically last year, also helped the overall portfolio. And maybe, Chord, it would be interesting for you to talk a little bit how we sort of allocate between domestic and international. It's one of the virtues of a diversification, and it really played well this year because we were hitting all cylinders, not only on asset classes, but also on the breakdown of equity.
no, without a doubt, portfolios were firing on all cylinders. All asset classes generated a positive return last year, and international markets outperformed U.S. markets by the widest margin since 1993, which is an interesting stat. We believe in global diversification, which means we're not only allocating to the S&P 500. We also have
So again, like global diversification means we are buying stocks and bonds sometimes all around the world,
all around the world.
right?
Yep.
So
Not just here in the U.S. We also have exposure or buying stocks abroad. In international developed economies, such as Rodney alluded to, such as Europe and Japan, and as well as emerging markets.
which can grow quickly if
Yes.
if everything's working. It's sort of like buying stuff on sale.
Yep,
Yeah.
absolutely.
I think part of trivia, we can say that Colombia was probably one of the best performing markets in the whole world.
Who would have
last
thought?
year. So
Yeah.
who would have thought
Yeah.
of that happening? So
Right.
there you go. A little piece of trivia is always fun to bring in.
Yeah, exactly. So when we talk about like sort of the equity, the stock portion of our portfolios, like you said a year ago and you were looking at 25 and you're like, it played out exactly like we thought it would. It didn't. There were things that we like called, and there's things like surprises. Like what did we do well, I guess, and what are we saying? Wow, better to be lucky than smart, and we didn't necessarily call that one, but we got lucky.
Well, the market certainly exceeded expectations.
Right.
But every time I say that, I think about how do the markets ever really just deliver
Yeah.
upon your expectations?
right.
They either
Yeah, that's true.
exceed your expectations in terms
Right.
of the return they generate, or they disappoint.
Yeah. Right. That's true.
They hardly ever generate that.
You don't ever get it exactly right.
Yeah. And you always have the contrarians in the market, right? Many times some of the big financial institutions will come out with reports
Yeah,
and
somebody
whatnot,
said this, or-
saying that, I mean, the word recession in the last 2 or 3 years was always thrown around several times, and it didn't happen. And the reason it didn't happen, there were lots of reasons why it didn't happen, but we had our convictions, right?
Yep.
I mean, we got to give ourselves a little credit. We
No,
had our
that's what I'm
convictions.
saying. Like, what are
And-
the things
and-
that you guys a year ago were sitting here saying, look, we're going to our strategic plan for 2026, and we don't actually just do it for 1 year, but like, the plan for this year and what we think the markets are going to do, like what did we get right? The diversification, clearly, right?
Well, we got the
discipline.
diversification. We believed that corporate earnings were going to certainly improve. The consumer, which is a very important factor, right? If you're talking about the U.S. market, the consumer was still strong and spending, right?
Mm-hmm.
And there was a lot of skepticism about that. So I think that was one of the areas that we did well. Our belief in the international markets, they don't always work the way they work, but this year, as Chord rightly pointed out, they did extraordinarily well and helped the overall return of our equity asset class.
So we got lucky, glad we were there. Do we have one of those, or are we just everything did okay, so we were lucky and smart?
We were lucky in how well things played out.
Yeah.
We certainly were.
Is there anything that we didn't do that maybe would have hurt us, like we've had before? Like we've had, we've sort of like been conservative and what is the word I want to say? Defensive, right? Like, is there anything that we elected not to do from some of the advice that we get?
Yes, I would say that's right. I mean, and it was almost it would have been a very small percentage of the overall portfolio, but you got to recognize that gold had an extraordinary year last year.
Right.
I mean, it was by far right. But it's a volatile.
But you guys talked about it.
We talked about it
as an
it's
investment
a volatile.
committee.
We've been talking about it for years.
Right.
Yeah.
It's a volatile.
Yeah.
I mean, Bitcoin, interesting enough, for most of the year did well, but it ended up down for the year towards the end. But there again, it's a very volatile market, and it's something that, our overall approach, right, is to safeguard our clients' investments.
Right.
And so we're going to tend to be a little conservative in that respect, right? We're not there to take big bets.
And Bitcoin is probably not something that you would have, but gold is something we've talked about for a long time, and that, we didn't put that in the portfolio in 2025 for a reason, and
and
good or bad. I just
but even though gold did extraordinarily well, if we would have put it in a portfolio, it'd be 1 or 2%.
Yeah.
And so at the margin, it wouldn't have truly impacted the overall return.
Right.
And that's on the upside. But on the downside, it's just visible. And so even though it's a small percentage, it may create angst with our clients, if they focus on it, because it's a volatile asset class.
And you're not being, compensated or paid to wait to see through the downside, because it's also not generating any sort of cash flow.
Right.
Or dividends.
Right, exactly. Which I think that's
earn in the meantime.
Yeah, that's a hard thing to understand. Gold is there. Everybody thinks, gold is great, but like seriously, you can't do anything with it.
Right.
It's like, at least if you own oil, you can sell it. Right? I mean, there's other things that you feel like gold. I just feel like nobody wants your gold necessarily. But
it's hard to find like what the true value should be for gold.
Right.
It's largely driven by supply and demand.
Yeah.
So there are a lot of different factors that drive the price. And
But if we're allowed to brag a little bit, Chord, I think, why don't we share a little bit, the private credit piece, because it is an asset that has really helped.
So that's like very hard to understand. So we're going to have some explanation of what private credit is.
Before we dive into that, the only other point I'll make about last year, and one thing we could have done in hindsight, was to buy more stocks when the market did experience that sharp and sudden sell-off
in April,
following the tariff announcement. In hindsight, we could have
but there was
accumulated more stock. There was a lot of uncertainty, and the speed of the sell-off and the rebound was extremely fast.
Right.
So
Right.
Which sometimes it's okay not to be part of that, because then the next time you're like, oh, should I be in it or not? I mean, it can be contrary to the discipline, right?
It can be.
And then it's sort of the lens you look through gets a little tainted, like what was successful last time, or it wasn't, right? So I think that speaks to the discipline, that when we do things like that, because we have the discipline, we may not react to something that happened super fast. If it happened over...
And it's very uncertain.
Right.
I mean, so much so that all the economists were wrong about the impact of that event, right?
Yeah.
All of them were wrong,
Yeah.
which tells you the level of uncertainty regarding that.
Yeah.
So.
Yeah, okay. So hindsight's always fun anyway, you know, like, okay. But so bonds, they were boring. And everybody thinks of bonds as very boring, but did they do anything other than what we like them to do, which is sort of keep the portfolio stable? Bonds were just sort of, they're just sort of there. Nobody really likes to talk about bonds. Everybody's like, why do I have bonds in my portfolio? You know, until you need the bonds in your portfolio because the market's tanked. So back to our discipline again, and the fact that, you know, we do have a portfolio that sort of hedges on both sides. It protects,
Right.
you know, yes, we take a little bit on the upside, but, you know, we aren't also going to take the hit on the downside. So bonds do anything?
Yeah, no, it was a good year for bonds. The broader bond market was up about 7%.
Which is a lot for bonds, no?
It is.
I mean,
It
that's
is.
a pretty big number.
No,
I
it
mean,
certainly is, and
it's usually like
contributed to
low
returns.
single digits ish, right?
Oh, yeah.
Yeah. So
This is the first really good year we've had for bonds in quite a few years.
yeah.
So that was good to see.
So all our clients are going to be like, "Oh my gosh, I'm so happy I have bonds," even though nobody.
Well, and especially tax-exempt bonds, right?
Oh, yeah.
I mean, at least the interest component is tax-free too. So
Right.
they rallied as well. So that's
They did, and you know the role of bonds is twofold. So it's to generate a steady stream of income, and to provide ballast in times of equity market stress. Meaning you know when equity markets go down, bonds should hold their value if not generate a positive return.
Right.
And that role was really reestablished last year, as we saw. You know during the sell-off in April, bonds generated a positive total return, helping to offset that decline.
right.
Yeah. Yeah.
And it helped the context, right? The Federal Reserve, you know, lowered interest rates by 75 basis points. So that also helped, you know, the performance of the bonds.
Or 0.75%.
Right. Yeah, exactly. I was just going to say, this is, I'm really trying to get you guys to talk in English, and I'm realizing, like, we have so many acronyms and letters and
We do.
Yeah.
the words
We
that
do.
we
It's
like,
just-
we speak a different language. If like, I'm really trying hard to listen to this in terms of like, what is somebody who's not in this industry thinking? And I'm thinking, you guys look like you have 4 eyes, like each, you know. And I'm like, how am I supposed to explain this to them?
That's all right. That's all
you
right.
know,
You're covering
so-
for us. It's
So
good-
I'm trying.
Good
I'm
teamwork.
trying to
It's very
not talk
good-
about
very
like,
good
what the
teamwork.
Fed did and what interest rate did and how that impacts the bond market and the stock market and corporate earnings and stuff like we pay you guys, like I said, to sort of keep this, keep the high level to us that need high level, and you guys can dig into the stuff that you're passionate about, because that's clearly not what I'm passionate about.
Goes
but
under the minutia category.
that goes under the minutia category.
That's
No
all right.
offense, but
Yeah.
you know.
That's all right. No offense taken, right, Chord?
Yeah.
Nope.
No,
Nope,
this
not
is,
at all.
This is why you guys are
Yeah.
good at what you do. So, I think anything else you guys want to share about 25? I mean, I feel like I'm asking questions, but you know, trying to keep us like, what do people need to hear? Like, I think, you know, you're at a cocktail party talk. What's the cocktail party talk about 25? Like, cheers. Like, it was good.
Yeah, it was
Right.
good,
I think-
particularly for investors diversify globally. Because a
Yeah.
lot of people had given up on
Yes.
allocating to international equity markets,
Yeah.
and 2025 was a great illustration of the power of staying the course,
Yeah.
sticking to a strategic plan,
Right. Right.
and then
I would agree. I mean, that's really the key part of it. You
Yeah.
know, diversified portfolios over time will really provide, you know, a steady return to the portfolio.
Right.
So,
And
you
we're
know,
so
you're obviously going to
fortunate.
have some up years and you're going to have some
Sure.
down years, right? But if things work as they're supposed to do, some things will offset others. And so in a down year, it'll be less down, if
Right.
you will.
Right.
And in an up year,
Right.
you know, you can be lucky like we were in 25, where all the classes did well and have a superb year.
Right.
And
Right.
that's sort of a dream for the investment committee because, you know, our clients
Yeah,
are
it makes your
obviously
job
delighted.
easy on
Yeah,
those
it
on
certainly
those
does.
days. I will say, like, it does work because we've had some clients for long periods of time. We looked at one last week with a client, and you know, the actual principal, without having been invested, would be negative, right? The principal invested would be negative. So if they didn't invest it at all and just spent, right? and they have lived off it for like over 30 years, and there's still enough to live on until they're 100.
In some
And-
cases, more
Which-
than,
Beautiful
than
thing.
their initial amount that they put in.
No, that's what I'm saying.
Yeah,
The capital
right.
invested would be negative
Right.
if it hadn't been invested, and they still have enough money to live on to 100. And so, you know, for anybody that doesn't care about the investment performance and doesn't want to talk about that stuff, I get it, because there's a lot that you don't understand, and you know, you can scratch the surface, but it still doesn't make a lot of sense. But when you start looking at returns like that, and knowing that really the bottom line is you can still live on the money that's been invested, and how important it is to invest it, because you know, 20, 30 years later, it's more than what it would have been. And that's why we have a diversified portfolio. That's why the diversified portfolio and the discipline. And I think, you know, it's great for you guys to talk about this stuff behind the scenes, but really the bottom line for the clients that we serve, we're so fortunate that you guys have given great returns, because like it's impacting lives, right? I mean, people's lives are different because
Absolutely.
of the investment performance. So I don't have anything else. Do you guys?
I think it's a great way to close, right?
No, this is how we close. Ready?
Yes.
On that note,